Good morning and welcome to another edition of the Main Management Market Note for the week ended May 15th, 2026. As usual, I'm Alex Varner, Managing Director of Research, alongside
James Maxwell, Director of Research.
Hey, we got upgraded. Here's our offerings. SECT, as usual, TMAT, INTL, and BuyW. The links on each of those boxes go through to our website if you have more questions to ask, alongside the custom model partnership opportunities down below. For the performance ended the week, more red than blue. I think inflation weighed a lot on kind of sentiment. The S&P did eke out a basically 0.1, 0.2% gain. I think that's the seventh in a row, which is a pretty solid streak. But you see the NASDAQ was, just barely negative at down 0.3. The laggards were Euro Stocks 50, that's Europe kind of large caps, and the EM down 4.2. Commodities, again, continuing their massive run, up 4 in the week and 48 year to date. On the right there, you can see the sectors, again, heavily commodity favored on the energy side, up 33. Then tech has just been ripping, up 22.5 now, and materials up 11. I think I saw something where, momentum, and a lot of that's kind of tech as well, but had like a 3 standard dev move in the last 3 months or something, up 25%, which is just kind of remarkable. 3 standard deviations, you don't get that very often. And then just for the week, energy again up, around 7%, healthcare up 1.1, and the laggards are real estate and discretion, which don't love the higher rates, I think. On the recession dashboard, not a ton has changed here. For the data this week, CPI and PPI were the big data points. CPI was up 0.64% month over month, basically in line with forecasts, but it's now up 3.78% year over year. That's the most since May of 2023. And you can see it's maybe breaking out of that kind of range bound area we've been in for the last couple of years. It's 3 years now. But again, that's up from 2.4 to 3.8 in 2 months. And again, that's mostly on Iran, Hormuz, which hopefully will prove to be transitory. We're now in the transitory versus temporary semantic game again. But obviously energy's played a big role, and then you saw a one-off adjustment on shelter that we'll address. On the right, you saw core CPI jump basically 0.4% month over month. Biggest monthly reading since Jan of 25, and it's now up to 2.74% year over year. And again, energy is excluded from that core reading, but the big increase in April is driven by kind of a one-off upward adjustment to shelter, which you can see on the right here. That was up 0.61% month over month. It was a one-off upward adjustment to rents and OER, owner's equivalent rent. But that's the biggest month over month increase since September of 23, and then pushed the year over year figure back up to 3.3 for shelter, highest in a few months. I think the idea, people are kind of looking through this one because it is a one-off adjustment. The optics are pretty clear. Which should help, maybe the next month's reading be a little bit more muted. And on the left, this is, very consumer facing, but gas prices are up bigly in the last couple of months here. It's up 5.44% month over month in April after jumping 21% in March. That was like a record gain monthly, basically. And they're now up 28.4% year over year, which is the biggest year over year increase since July of 22. For perspective, WTI crude prices are up around 50% since the end of February as the strait remains closed. So we're still trying to kind of work through this.
Yeah, and I think gas is one of those things. It's so consumer facing, and people are so sensitive to it because it is like the largest kind of single thing that you're purchasing that's moving around
on a weekly basis.
On a
and
weekly
you see
basis.
driving by, even if you're not filling up, you see the gas station. They have the prices displayed.
Yep.
And you're not wrong when you perceive that they go up faster then they come down. When gas stations are marking them up, they're much more quick to mark them up and much more slow to mark them down. So that's not favorable for the consumer, and as far as optics go and pricing right now. On the PPI side, this is the producer price index, tends to lead CPI by, call it 1 to 2 to 3 months. But PPI jumped 1.4 month over month in April. Core was up, where was core up there? Up about 1, both, basically triple expectations, which is just big gains there. The concern here is this flows through. I've seen a couple of pieces where they're saying, hey, the way these are calculated, the baskets are different from CPI and PCE. So there's going to be maybe more muted feed through, but directionally, you're still getting, rising inflation in the coming months as we head into the summer. On a year-over-year basis, PPI is now up 5.6%, call it 5.99, and core is up 5.24. Both are the highest since December of 22. So, that's definitely a concern. Higher January prices also spilled into the core a bit, where you saw transportation and warehousing up 6.4 month over month. That's a record high there.
Mm-hmm.
And then PPI, as we mentioned, does tend to lead CPI by a few months. So don't expect CPI to kind of start calming down anytime soon, unfortunately, as we continue to work through this kind of Hormuz issue. The good news is that retail sales, consumers continue to spend. Our April retail sales were up a solid 0.5. I think the month prior was revised higher. Total retail sales up 0.5, and core was up 0.5 as well. X autos were up 0.7. Again, this is kind of they measure the retail sales on a dollar basis. So part of this is when people are spending more dollars at the gas pump, it inflates this retail sales. But if you look at that core figure, that is still positive up to 0.5. So it's good there. This to us says the consumer remains resilient despite the recent jump in energy prices. The concern is if this weighs, kind of drags out over the summer, you might see some slowing. But again, we've yet to really see any evidence of that thus far. On a dollar basis, all three categories that we just covered are at absolute highs, with retail sales now up to $757 billion in April. And then these categories, they're also all accelerating on a year-over-year basis. X autos is up 6.3, the highest since Feb of 23. Total retail sales are up nearly 5, and core up even closer, both up 4.9, 5%. So you're seeing this acceleration despite the rise in energy prices, which we think is indicative. Most of the GDP numbers I've also seen have been revised up. Which is,
that's one thing I was going to say is, it's one thing if you have inflation and slower growth, kind of that stagflation environment, that's kind of the worst environment for a lot of things, for equities, consumer sentiment, all of that. But when you have higher inflation and stronger growth, kind of this higher nominal growth, which you kind of see somewhat in the retail sales along with some other data points, that's less bad. It's kind of overall good. It's typically what you see later in the economic cycles is kind of hot inflation, hot growth, just overall running it hot kind of environment, which is not a necessarily terrible thing.
Yeah, and I think I saw something this morning where, I forget which bank it was, one of the big investment banks just said, hey, we're now initiating our Q2 26 GDP forecasting, and it's at 2.5%, up from 2. So that's, and they were waiting for retail sales to kind of move their baseline, and it moved up. So I think you're seeing that's a good sign where we're not, seeing this kind of entrenchment of growth. Concerns that it's
demand destruction, nothing like that.
Exactly.
Demand destruction.
Speaking of, solid industrial growth, industrial production was up more than double forecasts, up 0.7 month over month. Manufacturing output up 0.6, also basically triple forecasts. Both monthly readings were the biggest since Feb of 2025. On a year-over-year basis on the right there, there's multiple lines there, but the kind of lighter weight lines both moved back up. So industrial production's up 1.4 year-over-year, manufacturing up 1.4 as well. The index, interestingly, that dark blue line for industrial production is back up to 102.5. That's the highest since August of 2019. It's like a 7-year high, a 6.5-year high. And the output index is up to 98.7. It's highest since April of 22. It goes like half a point higher. That is also going back to pre-COVID levels. So you're seeing this ongoing growth in the manufacturing sector. It's been borne out also in the PMIs, manufacturing PMIs, which are stronger than the service ones, which has not been the case for a while now. So showing more strength in the service ones, which has not been the case. So this is good for the manufacturing sector.
It's the exact same story, like pro-cyclical, pro-growth. Yes, there's inflation that's part of that too, but it's fine because we're getting growth to kind of make up for it.
And one of the complaints you're seeing is, we keep talking about inflation, and people are like, well, how are, I had somebody email me this week just saying, how are markets at new highs? But CPI, PPI are like moving back higher. It's like markets are essentially looking through CPI, PPI. They're looking at all-time highs on the earnings, and companies aren't showing any signs of faltering there. They're saying, hey, we're not going to wait around for this Hormuz issue to go through. Yeah, it stinks. The consumer doesn't like it. So far, the consumer hasn't batted an eye. So,
also for inflation, I know we've looked at this. If you look at kind of asset class returns during higher periods of inflation, equities are, if not the best, maybe second best, right behind the commodities.
Kind of a hedge against
inflation. To be a hedge against inflation because companies can raise prices, right?
And that's one of the concerns is people are, the pundits are saying, hey, these earnings are really strong because companies are just passing the prices through to consumers. And you've yet to see the consumer really push back and say, hey, we're not going to pay these prices. So I think it's, it's been a non-issue so far. On the household debt side of things, we got the Q1 measure of household debt. On the left there, you can see it increased by $18.3 billion to an all-time high of $18.8 trillion. That's now up 3.2 year over year, kind of trending mostly sideways for the last couple of years here. Margin debt posted its lowest increase in 5 quarters, while credit card fell 25 billion quarter over quarter, and then auto loans jumped 18 billion quarter over quarter, the biggest gain in a few quarters. On the right there, there have been concerns around the delinquency level. I think on the right, you see the orange and the darker red lines are moving higher. Those are kind of the two most delinquent categories. However, don't forget that green line. That green line is at 95%. That's current. 95% of all debt is current. We're right in line with the historical median. Even on that dark kind of red line, it's just back. It's now back up to its median. Median. Not above, not really flashing. Yes, it's moved higher. You don't love that. The orange one is a little concerning. That's up a little bit higher. But again, combined, those are 2.3% of the total debt. So the point being is that, yes, people are looking at this directionally, but I think it's important to remember that the vast, vast, vast majority remains. And this is also kind of can be conflated, or I guess not conflated, influenced by student loans, which the prior administration forgave them. So they basically just fell off the delinquency sheet because people are like, great, I don't have to pay student loans anymore. 4 years later, 5 years later, the current administration says, nope, sorry, we're not giving you free money for all those student loans. Get back paying them. So people are cycling back into paying these loans that they probably just forgot about for 5 years. So that's an issue as well, just from the kind of the logistical standpoint. But I think, a lot of the student loan stuff is kind of separate from autos, consumer credit card mortgages, which for the most part remain solid. I think anything they took down on delinquency. So that's kind of the high and low of it for the week for May 15th. Again, core and headline CPI posted solid increases in April. Headline CPI is basically now 3.8. So, kind of it's double the Fed's target. We got Warsh in now. There, I think, as we've talked about, the 2-year, our CEO Kim talked about this morning on our internal morning call, but the 2-year is kind of pricing in one hike by the end of the year, whereas the longer term, longer dated 10, 20, 30-year treasury yields are more normalized because markets are looking through, and that's a longer term view of inflation. PPI, basically triple forecasts. Concern here is they feed through to CPI, but retail sales so far still up solid again in April, showing that consumers are not entrenching yet. And then you also saw industrial production and manufacturing output come in well above forecasts, which is good for the industrial manufacturing sector. And then household debt ticked up to a new all-time high. But again, it's only up 3.2 year-over-year, and delinquency rates are kind of, increasing a bit, maybe on the margin, but 95% of debt still current, very much in line with long-term levels. So that's kind of it for this week. We appreciate you joining us and hope you had a great weekend.
All right. Thanks
again.